Welcome back, everybody, to a brand new episode, and this is going to be under the road to success. And you know the deal, so the first thing we're going to talk about, basically an update in terms of how my life is going so far, what things have changed, what things I can learn upon, what things I can tell you guys about. And definitely, first thing I want to say is we're trending in the right direction. I just came back from my family vacation in Barbados. Before I went on vacation, I did get the news that I did secure a job that I start next Monday. So that is very exciting. It is a recruitment consultant job, and it's going to be something I look forward to doing. I've no experience on in the past, but I look forward to doing it. I'm going to be commuting into New York every day, right next to the World Trade Center. So definitely look forward to that, and that's definitely a positive development that we've had from the past. Now, even though I did get a new job, the money is still fucking tight as shit. So I have, obviously, my first day of the job next Monday. My first paycheck won't be, I don't think, until the third week of August. And right now, you're looking at a guy that's got $80 in his bank account to make it until that third Friday. So definitely not something that is a comfortable space to be in any sense of the word, but it's something that if there's anybody who's watching this at any point worried about money and worried about not having enough or not being able to do certain things because of what they make, just know that I know exactly how you feel. I'm on a budget right now for about $20 a week, and gonna try my fucking hardest to get there. Gotta go to get some food today from ShopRite. But anyway, so that's gonna be a roundup and a wrap up of how I'm doing myself. Obviously back in the apartment. Apartment's doing well. Nothing else is going on with my life so far. So we're just going to wrap that up, get right into the next topic, which today is going to be similar to my last video that I put up in terms of breaking down the economic model, which was the quantity theory of money, and basically extrapolating that into what the fuck is actually going on with that in terms of in the US and what consequences that brings about and what benefits it does. So first thing I want to say is that quantity theory money, the big takeaway, just want to come out of it, is the velocity of money. So velocity of money has been very much steadily decreasing for the last 20 years, and definitely so in the last 10. And the velocity of money is just the amount of times that money changes hands in the economy. It's basically straight and simple. Because of the fact that our monetary base has exploded with all of our central bank policy in terms of buying up assets and doing quantitative easing and increasing the balance sheet, we have seen our monetary base explode, but you haven't seen that inflation increase because of the fact that the velocity of that money is very much close to 1. And it's basically money that the central bank and a lot of other financial institutions are putting onto the balance sheets and not touching. So whether it's the form of a stock buyback, it's the form of just quantitative easing, like I said, where that ends up being put on a central bank balance sheet and laying there and staying there. That is why the velocity of money has gone down so much. Now, what the consequence of this is, and the benefit, I'll go over the benefit first. Good news, always want to go first, is that it has definitely helped out people who are invested in the stock market. So if you've been invested in the stock market for the last 20 years and you didn't touch any of your money, depending on what kind of expense ratio you're playing with and what kind of vehicle and instrument you're in, you probably are way higher now than you were before. And that's a positive thing, because there's a lot of families, there's a lot of people who do have money in the stock market that has seen that grow. And that's partly why we've seen a generally good economic success in the last 20 years. God forbid we did have the Great Recession and the financial crisis, but especially after that, you did see markets. I mean, markets have been more than doubled since where they were at the bottom of that financial market in 2009, and they kind of had not stopped. They had not retraced, really. You've seen small retracements, 10%, but besides that, everything has made new highs and has kept going higher. And the real consequence you see from this, and what a lot of liberals or Democrats would say, and even, I mean, a lot of Republicans too, or conservatives would say, that you have a big and a growing financial and income and wealth inequality gap growing. And now, the biggest reason for that gap is your capital markets. So if you have someone who is just getting paid a wage, and you got someone who's getting money and wealth through capital returns or stock market returns, your wages are not increasing at any rate anywhere near what you're getting in a market return. And that's why you've seen definitely this divergence in terms of your increase in your income equality. So the one thing you could argue is, now wages haven't gone up a ton, but you have seen wages increase a little bit in comparison with inflation in terms of your real increase in wages, but nowhere near your market returns. And that's definitely what is causing a lot of your income and your wealth inequality. And it really comes all back down to the Fed. And the Fed is something that, with its quantitative easing and its goal, ideally, of creating the lowest possible unemployment and stable pricing at 2% inflation as of recently, it's done its goal. It can say it did that goal, but it has also made some very bad consequences, and that's that wealth and income equality. And when you have that wealth and income inequality, the more extreme that it gets, the more problems we're going to have in society. Whether it's just people not being able to live right, decrease in the standard of living, the loss of the American dream, your issues with seniors, and your issues with kids coming out of college. Like, you're going to see a split, and it's not based off race. It's based off exclusively those who have money in the capital markets and those who don't. Now, and it's tough because a lot of those people that don't have money in the capital markets would love to have it there, but they don't have that extra disposable income in which they could do it. Some people who make a decent income already and who save that money are able to develop that, and it only compounds that once you get from generation to generation. So you have a single generation of a family who has had money in the stock market or money in real estate for decades. It's passed that down, and that continues to compound and continues to grow at a rate which, once you get into your decades, it's not something that someone who's starting could ever imagine to touch. So that's something that it's a real shame, and I would really like to see that change. I'd really like to see something be done about it before it gets to the point where you get to that tipping point and you have some kind of crazy outlash in those cases like that. And you do have the aspects of automation coming. You do have a lot of issues on the horizon which can affect that in a serious way. And we're sitting at a spot now in the economy where we have done so well, and we're doing so good right now, and we're so sound in terms of a financial balance sheet aspect, that this is the time to tackle those problems. The only thing I could think of is having some kind of either correction in that market pricing or adding more people to that market. Now, my only issue is I personally think that the market is a little overinflated. Now, it's supported based off the Fed and based off fiscal policy and a lot of other things that we have going on. So it's not overvalued in a modern sense, but it's overvalued in traditional sense, where you have companies that are borrowing for essentially nothing when you have interest rates near zero. You have governments who are getting paid to take on debt, like the ones in Germany, where their entire yield curve has gone negative. And it's something that we really have to look at. And if you guys have any suggestions or comments in terms of if you guys have ever thought about it, or your guys' thoughts in terms of what we could do, be happy to hear those. I'd be happy to answer all those comments, as well as get one of you guys to come on and include yourself in the video next time and have a little back and forth in terms of what we think the next steps could be made. Obviously, you just make a comment here, you message me on Twitter at my handle at stclair14, or even send me a Facebook message. I care less. But my goal and my idea, even though we will see a lot of pain, the only way I think you could get through this without pain is some kind of change in mentality, where you do have that kind of modern monetary theory, but it's not sustainable, and it's something where you can get out of it without paying short term, but your long term, you're still affecting future generations in a negative light. I think it's a matter of taking the pain now, in terms of rather than taking the pain later. And that's something where we've kind of pushed this stone down the hill until it gotten to the point where it's an avalanche, where it's going to take us all out. And it's something where I think you see a correction. You could see a correction, I mean, to be honest with you, of 60-70% in your indices. You go from trading 17 times future earnings to 5 times future earnings, because of the fact that you get a yield curve back at a reasonable amount, back to a spot where your fundamentals start to make sense, where Germany is no longer borrowing and getting paid to borrow at a negative yield with no gap in sight in terms of a spending limit or a spending cap. And you have places like, you have companies like Chewy, or you have companies like Netflix or Tesla, who are able to borrow money, millions and billions of dollars, at a very low yield, because of the fact that your risk-free market rate, or your R squared, is crazy small. It's on an international level at probably around 1%. In the U.S., you're just right now with the falling yields at just under 2%, but it's something where I don't see it being a catalyst for sustainable growth. And I think that's what this should be all focused on, is sustainability and sustainable growth. And just to let you guys know, I do have some of the markets up now. We're looking at definitely a nice turn down in the dollar weakening, as well as a very big strengthening. And it's weird, very big strengthening in the euro, very big strengthening in things like the pound and the yen. I mean, the yen and the franc, which you do see strengthening, is understandable, but the euro and the pound strengthening versus the dollar is a little strange. But I want to wrap this all up by saying that once you do have this correction that we are going to see, I believe we're going to see this market correction within the next year, within the next 12 months. And I'm talking more than a 20% drop. I don't know how low it will go. That is something that's tough, that will be dictated on how the Federal Reserve plays it, how this China thing goes down, how the Europe fiasco goes down, how Brexit goes, how the election goes. So there's a lot of headwinds that are coming up, but I don't see us, I shouldn't say 12 months, I'll say by election date, by the end of 2020, we're going to see more than a 20% correction in the market. And we did see a big bad day today, and honestly, I wouldn't be selling. I don't think it's over right now. I don't think the I don't think now's the time, but you are starting to see cracks, and especially with this U.S.-China thing. I would personally, I mean, don't take any of this as direct financial advice, but I've positioned myself heavy into gold. I would definitely be advocating for that. I've been in gold now for 2 or 3 months with a good, nice little steady return out of that. I'd be getting out of all of your high growth names, your Stitch Fixes, your Chewies, your IPOs, your enterprise software companies. I'd be getting out of there. I wouldn't be in financials. I'd be in your utilities, and I'd be in gold right now. And I would take bits and pieces from the market. Like something I like really a lot right now is Verizon. Verizon has done me really well, and I might end up putting up right at the bottom of this video, or maybe on my next couple of videos as I start to edit it, the price of Verizon. My pick of the day right now is Verizon, and I'll put that as there, and I'll add it to a portfolio in which you guys will be able to track. I might do it in a sort of Google Drive sense, and then we'll see from there. But gold and Verizon's my pick of the day. Gold I've already been in, but I wouldn't be chasing gold now. I'd be waiting for a pullback. Once you see kind of the capitulation in the stock market and you see buyers coming back, I would be buying gold on a pullback. But I like Verizon right now. Verizon's probably coming off a pretty rough day today. I don't see it right now, but it'll probably be at the bottom of this video. And that's definitely something that we'll want to see. So that's about it. I'm gonna let you guys go now. I'll come back with another video tomorrow. I'm gonna go crazy. I'm gonna go do this every day, and I've been trying to say that for a while now, but that's my goal. And in terms of Verizon, my pick of the day right now in stocks, my pick of the day right now in Forex is going to be honestly short. I want to be short a Aussie dollar or short your dollar yen. I don't think those are places where you're going to see much recovery anytime soon, but I wouldn't necessarily be chasing them. I'd be either staggering in on small entries as you see it come up, or I'd be going all in on a pullback into a quarter zone, so a 25-75 zone. But anyway, that's gonna wrap up this video. In terms of commodities, be long gold, and I don't take this is a disclaimer, I am not to be trusted as a financial advisor because I do not have all the legal bullshit to back that all up. But if you guys were interested, that is what my positions are in now, and you guys will do with that as you may, obviously, but I just want to let you guys know that. But another chart I want to have you guys look at today is look at your yield curve. Look at your U.S. yield curve, and tell me what you guys think, and we'll talk about that in the next video. But alright guys, peace out, have a good rest of your day. Bye bye.